The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Katie Greifeld. Matt Miller will be with me momentarily. Let's take a look at these markets and where we stand with just about an hour to go until the bells ring. You can see quite a recovery underway in the S&P 500, down by more than 1% earlier, now slightly green. The Nasdaq 100 trying to get there as well. Not quite there yet. We'll keep a close eye on that. A well-behaved bond market at the moment. Not too much going on. Yields trending slightly lower. We are getting closer and closer to 4% on that 10-year Treasury yield, all as volatility comes out of the VIX. Now we're trading with a 19 handle. If we were talking about that figure about 2 weeks ago, we would say that's pretty high, but 19 in this environment, not too bad. In any case, a volatile session on Wall Street, really giving credence to strategist warnings to dip buyers that there's more turbulence ahead. Stocks erasing all the losses that dragged the S&P down 1.5% earlier today. But to market watchers, as firms like Morgan Stanley and JP Morgan Chase, equities are due for skittishness in the short term. Year end, it might be a different story, though, with Tudor Investments' Paul Tudor Jones saying he has lofty expectations for the NASDAQ.
I think I want to kind of wait and see where we are in a week or two time. But my belief is that we'll be substantially higher by the end of the year.
Now, a big part of that volatility is the back and forth out of Washington, D.C. Wall Street keeping a close eye on two sagas out of the nation's capital, the shutdown and the China trade wars. Now, those resurgent trade tensions were a big part of why the markets were lower during the first half of the session after China sanctioned U.S. units of a South Korean shipping giant. But things turned around after the White House reportedly confirmed Trump and Xi are still set to meet, followed by comments from Fed Chair Jerome Powell's midday speech that boosted rate cut bets. Now, we're also in the midst of yet another market catalyst, with the big banks unofficially kicking off the next earnings season today. We had eToro's Brett Kenwell noting earnings beats could help steady the ship amid potential signs of volatility. And the big banks certainly delivered strong third quarter results, but JP Morgan CEO Jamie Dimon is still warning of uncertainty amid, quote, complex geopolitical conditions. And Matt Miller, I promised, is here now to tell us about all of that.
Well, I just wanted to point out something interesting. First of all, it's great to be here with you.
Yes, thank you for coming over.
I'm honored to join the close from Business Week. Look at this chart. 4 of the biggest banks, the big 4 that reported today, have almost doubled their stock buybacks in what was the first full quarter following the Federal Reserve's annual stress tests. You can see that JP Morgan, $8 billion in buybacks. And most interestingly here, I think we heard from JP Morgan that they don't really feel comfortable buying their shares at these prices, at these elevated prices. That's I'd say a pretty courageous thing to say. And you can see that JP Morgan shares are actually down today. Only 2 of the banks on the KBW index are down. JP Morgan and Goldman Sachs are those 2. Citi quintupled its buybacks in this quarter, $5 billion from $1 billion. And Wells Fargo also boosting buybacks massively, up to $6.1 billion from $3.5 billion in Q3 2024.
Let's talk about Wells Fargo specifically, because I'm pleased to say that joining us now is Mike Santomassimo. He is the company's CFO. Mike, great to have you with us. We have to start with the return on tangible common equity being boosted to 17%. That is your aim here. The previous expectation, your prior guidance, was 15%. So that has certainly turned a lot ahead. So starting there, what is going to drive that growth in your view?
Yeah, well, thanks, Katie, Matt, for having me again. You know, like I think you got to look, rewind the story a little bit where we started this back, you know, the end of 2020, early 2021. Our return was 8% back then. You know, we're approaching, you know, a sustainable 15%, you know, that we committed to, you know, a couple of years ago. And that's really driven by a number of things. One, it's, you know, the investments we've been making in all of the businesses that we've got. We're starting to see some of those returns. It's all of the efficiency work that we've done. You know, we've, you know, through the end of, when you get to the end of this year, we'll have saved, you know, $15 billion of gross saves over that time period and reinvested most of that back in the businesses. And then we've optimized our capital. And so now that we're at that, roughly 15%, now it's time to set sort of the next milepost for us, which is the 18% goal that we put out there. And really, it's going to come from the same things. It's going to come from, continuing to execute across all the investments we've been making, credit card, investment banking, the markets business, wealth management, the core consumer businesses. And that'll be, a big piece of it. The second is just continuing to do the work that we've started on efficiency. We still think there's a ton more to do across the whole company to make the place more efficient, more responsive to client needs, more flexible in terms of our approach. And then continuing to sort of optimize capital and then use that capital to grow, the businesses now that we don't have the asset cap in place. So it's really a lot of the same things that we saw come through over the last, couple of years.
Well, let's talk a little bit more about efficiency. Where do you see scope for more work to be done when you think about further cost cutting? What areas come to mind that you need to maybe trim a little bit before you really focus on growth?
Well, I mean, we're focused on both, right? And a lot of the things that are going to drive growth are the things that we've been reinvesting in over the last four or 5 years. But the efficiency is really going to come from a little bit of everywhere. More process automation that helps us serve clients better. Less real estate as we continue to prune that portfolio. Less third-party spend, more efficiency across all the things that we do, internally. So it's going to be a little bit of across a lot of different areas, and it's at any given time, it's hundreds of different projects that are underway. They're going to drive that. But that focus of both, efficiency and growth is really, what we're working on today. It's really doing both of those together that I think will drive the returns.
Hey, Mike, Matt Miller here. Great to have you with us today. I want to ask about credit quality, given what we've heard out of First Brands and Tricolor and Jamie Dimon's talk of cockroaches. Your loan loss provisions were lower than analysts estimated. Are you less concerned?
Well, I think we're just telling you what we're seeing, right? Which is really good performance, and it's been very stable now for a number of quarters. And that's both on the consumer side, the commercial real estate side, really across the portfolios. And, on the consumer space, we're seeing delinquencies still trend down. We're seeing payment rates on credit cards still be higher than what we would have modeled. And we're not seeing delinquency trends get worse. And that's really across all types of clients that we service. Similar themes on the other portfolios. We're just not seeing that yet. Now, it's always, you always have to be thinking about different scenarios that could, to come to bear, and a lot of that's already embedded in the allowance that we have up, for these portfolios. But we're just not seeing it yet, and we're seeing just consistent performance and consistent activity levels, really across all the portfolios, which has been really good to see. But we all think about what those risks could look like, but we're just not seeing it manifest yet.
I'm curious about your auto loans business because I know you want to see some growth there, and because I just like cars. The market has been spooked by some subprime stories. I mentioned Tricolor already. What are you seeing in autos?
Yeah, I'm less of a car guy, but I think we've seen really good growth in originations now the last couple quarters. And while we're expanding what we do there with the likes of Volkswagen, Audi, and just more broadly across the portfolio, we don't dip deep into subprime, and we don't dip too far into that. And anything we're doing to be kind of a more full spectrum lender on like lower credit quality clients is very small in the scheme of our portfolio. So what we're seeing in what we do is actually performs quite well. And I think we're seeing good stabilization or good support for used car prices. We're seeing good performance really across the credit spectrum that we're dealing with in that portfolio. So we're not seeing a lot of that weakness, at least in our portfolio.
And if we do think about risks here, though, I hear what you're saying. You're not seeing those specific weaknesses when it comes to auto lending in your portfolio. We talked a little bit about credit quality as well. But, when it comes especially to some of your targets, what are the risks that investors should be thinking about here?
Well, I think you should always be thinking about different scenarios that you need to look at as you sort of look over a longer time period. But to get to our return targets, it's really going to take just good execution across a whole series of things that we've been doing now for a number of years, across growing each of the businesses, managing credit. I think if you look back at the company over a very long period of time, we've got a really deep credit culture and are very focused on sort of managing sort of that risk-return trade-off across the portfolio. And then it's continuing to get more efficient. And we think about all kinds of different scenarios, that could come to play. And that's why we feel really good about like the capital position that we have as we sit here. We've got a tremendous amount of excess capital, $30 billion worth of excess capital over sort of our required amounts. And so that positions us pretty well to think about whatever risk could be there. But as you said, in the near term, we're not seeing it. But I think we're prepared in case it does come, given the way the overall company is positioned.
Hey, Mike, we just showed the buyback screen again, which reminds me that your stock is the second best performer of the big six, only trailing and just by a couple percentage points Goldman Sachs over the past 5 years, which is a default window that I always pick to look at big stocks. Would you still be interested in buying back shares? Would you be interested in raising the amount of shares that you buy back going into this quarter?
Well, we have raised the share buybacks in the third quarter, and we said the fourth quarter is going to be about the same amount. At least that's our intention, is to do about the same amount as we did in the third quarter. And so we'll see where it goes from there. But I think we feel really comfortable, doing that, given kind of where everything sits today and our overall capital position, given how much excess we have today.
All right, Mike, great to get some time with you on what I know is a busy day. That is Mike Santomassimo. He is the CFO over at Wells Fargo. This is The Close on Bloomberg.
All right, we have stocks erasing earlier losses after remarks from Fed Chair Jerome Powell indicating the central bank's focus on the weakening labor market, and after Jameson Greer said on CNBC that Presidents Trump and Xi are still going to meet. Traders betting on an October rate cut from the Fed, and the S&P is about to close out its 98th trading session without a 5% pullback. Let's bring in Chris Brigati, Chief Investment Officer at SWBC. Chris, great having you here in the studio. It has been quite a run. I saw from BTIG a couple days ago that we've had 114 sessions above the 50-day moving average, and that's the third best, best since 1990. So, wow. Can this continue? This melt up?
I think we're due for some sort of a retracement. I mean, when you have these kind of runs, you're always...
It wasn't Friday, right?
Right. Yeah. I mean, Friday might have been the start, the first chink in the armor, so to speak. But ultimately, we're due for some sort of retracement just because the longevity of this seems to be getting a little long in the tooth.
So some sort of retracement, what would that look like when you think about, it's tech that has been leading this market up? Would it also lead this market down? I
mean, I think it could. We've had some hints in the past that might be the catalyst that really kind of drives it. So far, it seems to be almost Teflon in terms of its ability to sustain and withstand any downturn. But ultimately, if that does break, that will be the first shoe to drop.
The thing that's moved markets is anything on China. So if Trump says an extra 100%, or China's fine, or they have trouble with shipping, or that's what moves it. The AI bubble story doesn't seem to bother anybody. Are we in an AI bubble? Because 54% of respondents to a Bank of America survey said yes.
I think we're close to it. I don't like the term bubble. I think it's a little overextended in this case, just because I don't think this is ready to roll over yet. And I'm really kind of more thoughtful about when it does. Will that be more powerful? Will it be more impactful? Will it be a bigger downturn? Those are the questions in my head. And ultimately, until we see something that's going to derail it, I should say, then I want to see that happen first before I really see this as a bubble.
Okay, so not a bubble, not a bursting bubble. Maybe, though, we do draw down a little bit here. What do you do if you are anticipating that sort of movement? How do you insulate your portfolio or potentially position it maybe on the offensive side in such a scenario?
A couple of things. The obvious thing is bonds. I mean, the bond market is really kind of made to weather these kind of storms, and I think we saw that on Friday especially. The bond market really rallied, tested that 4% threshold on the 10-year Treasury as a result. So bonds is one obvious. But if you're looking for broader things, looking at things like consumer staples, which typically weather the downturn quite well. Things with higher dividends, ultimately those can weather the storm better, and ultimately you'll ride it out and be able to sustain.
I'm going to jump ahead of Matt here because I do want to follow up on that point on bonds. Interesting that you would look to bonds in this moment. The textbooks tell you that you should, but I feel like bonds have been such an unreliable hedge. How do you square that?
It's not necessarily a hedge. It's just like a different way of participating in the market and in a balance. And you talk about balanced portfolios. It's kind of something that gets a lot of play, especially when equities do kind of have that big sell-off or the big downturn. So it's making sure you have that balance in your portfolio. The unfortunate side is we did have a 4.80 10-year back in the beginning part of this year.
I remember that.
So the 4%. That was nice while it lasted. But ultimately, investors that participated at that point have really done very well in their portfolios thus far. So if you've already locked in some of those opportunities and gains in terms of being present in that market, it affords you the opportunity to be a little bit more thoughtful going forward.
Bonds just don't seem to be telling me what I feel like they should, right? At 4%, even with 6% budget deficits, we have a Fed that's cutting into an inflationary environment. You have spreads at all-time tights no matter what happens. It's like nothing matters in the bond market.
It doesn't seem to, which is unusual for bonds. Usually, the bonds are the pessimistic part of the market, and thus far they're not really acting that way. So I'm very, very concerned about what are we going to do to kind of ride out the storm and get us through this period of time. And ultimately, when I look at the opportunity, I think bonds can do a really good job. We're also a little bit kind of differently entertained, for lack of a better way of saying it, by the fact that we were at ZIRP for so long. I mean, those sub 1% interest rate period was not fun to be a bond trader in that environment. And yields and investors did not benefit as well. So finally we have attractive yields. 4% looks great compared to 1%. So, for the opportunity set for a longer term generational kind of opportunity, we might be in a point where it still makes a lot of sense.
Yeah, and in the grand fullness of time, ZIRP was not that long ago. So, Chris, really appreciate you stopping by. Come back soon. That is Chris Brigati. He is Chief Investment Officer over at SWBC. Now, coming up, big banks kicking off earnings season with JP Morgan, Goldman Sachs, Citi, and Wells Fargo all reporting results earlier today. We'll take a closer look at those reports with an analyst who covers the sector up next. This is The Close on Bloomberg. All right, it's time now for our top calls to look at some of the big movers on the back of analyst recommendations. And we start with MP Materials. President Capital initiating coverage with a buy recommendation and a price target of $92. The boost for the rare earth materials company comes as renewed tensions over China's exports of critical minerals are fueling investor bets on alternative suppliers for the U.S. Next in line, AMD. Wolf Research upgrading to outperform from peer perform and setting a price target of $300. The analyst cites the chipmaker's recent deal with OpenAI as the motive behind the raise, and more analysts may be following suit now that AMD just announced that Oracle will use 50,000 of their new chips starting next year. And finally, DoorDash. JP Morgan restarting their coverage of the firm with an overweight rating and a price target of $325. The firm says that DoorDash's acquisition of Deliveroo will expand its footprint in Western Europe and the Middle East. Shares right now pretty much flat. And those are some of our top calls. Now, speaking of JP Morgan, they are among the 4 big banks with earnings out today. So let's dive a little bit deeper with Erika Najarian. She is Managing Director and Equity Research Analyst of Large Cap Banks and Consumer Finance over at UBS. Great to have you with us, Erika. Really an embarrassment of riches when you think about the 4 companies that took the stage today. Which bank really stuck out to you in either a good or a bad way?
They all pretty much stuck out, but let's sort of, let's pick Citi. Right? Because I think everybody expects JP Morgan and Goldman to be who they are, which are best in class. And there are a lot of dynamics about the Wells stock reaction today that has to do with negative hedge fund investor positioning and essentially beating low expectations and setting, higher return targets or profitability targets. But I feel like Citi kind of got left out of the discussion. And I thought they actually had quite an excellent quarter because they not only had great momentum in markets and investment banking where the embarrassment of riches are, but in some of their more annuity-like businesses, like their services business, which is how they help companies move money around the world, that continued to be, strong. And they continue to control expenses and buy back a ton of stock. So in this sort of fever pitch of, wow, look at all these IB and markets revenues, I would actually point out, Citigroup as somebody that, stuck out nicely, especially relative to expectations.
And is absolutely crushing it year to date, Erika. Citigroup up 43% year to date now, and they outperform every single other bank on the KBW Banks Index. Is there more room to run there? Because David George from Baird today was talking about JP Morgan, saying, look, the company's great. It's a fantastic bank. It's well run, firing on all cylinders. But the stock is too expensive, which is why I don't have a buy on it. Could you say the same thing about Citi, or is it, has it not performed well over the last 5 years, which means it still could go higher?
PE is an output, right? What really matters and drives stocks is the E. So the reason why JP Morgan keeps going is because they continue to outperform on E. And that's really what Citigroup needs to do, right? That's why they've outperformed, not just because they bought back a bunch of stock and announced a $20 billion buyback plan, but they outperform on E. And by the way, they announced a May 7th Investor Day, which typically means refreshed targets. And so if they continue to raise the bar on E and PE doesn't sound so demanding, that could be a nice formula for shares, but that is the same formula for all the other banks, right? PE is all but a construct. If they continue to beat on E, then the stocks can continue to do well.
And Erika, we have just about a minute left with you, but I do want to talk a little bit about Goldman, not necessarily about the results, but the announcement from the bank that it will cut more jobs as AI saves costs. They're planning another round of job cuts, even though they do expect to finish the year with an increase in overall headcount. What do you make about their reallocation of headcount across the bank?
Look, I think Goldman is just doing Goldman things. Goldman has known to be sort of an innovator, given its concentration in its business. It tends to be a little bit more nimble than other banks that are a little bit more consolidated or diverse, so it has a lot of other business lines to think about. I think this is just the next step in Goldman's evolution in terms of, wringing efficiency out of its business. I don't think it's necessarily, sending a message other than Goldman tends to be a leader in terms of thinking about the future and how it services its clients in that way.
Erika, great to get some time with you. Erika Najarian there, Managing Director and Equity Research Analyst of large cap banks and consumer finance over at UBS. Coming up, Roger Altman joins us from Evercore. This is The Close.
Just about 3:30 p.m. New York time. This is the countdown to the close. I'm Katie Greifeld.
And I'm Matt Miller. We have seen a real gyration in markets, not just today, but over the last few sessions, right? Friday was a shocking fall from, we opened, I anchor the open from 9 to 11, positive. By the time we get to you and Romaine at the close, down 2.7%.
Yeah, it's often a different story between the open and the close. And it was interesting that we ended the week in such a way when you think about how much enthusiasm there was over AI and basically the spending that we were seeing by these AI companies, OpenAI inking deals left and right. That was definitely the big bull case at the start of last week. It had petered out by the end of last week. And here we are again, looking at this chart about all the talk about an AI bubble.
Yeah, I mean, it's interesting that the market swings have all come from, to some extent, China, right? Trump's tweet on China Friday, his tweet on China Sunday, a mention from Jamieson Greer today that she and President Trump would still meet. But the AI bubble is always there lurking in the background as sort of the bigger overriding story. We want to bring in Roger Altman right now, founder and senior chairman at Evercore. And, Roger, you have such a wealth of experience from banking to the Treasury Department to the firm that you founded. We didn't really know where to start, but I thought AI would be appropriate? Because you started Evercore in '95, and that's when, right at the beginning of the dot-com mania, where for the next 5 years it was just up, up, up. Do you see any parallels to what we're seeing, in this market, where we're up 25% a year, seemingly, on excitement for NVIDIA?
By the way, wealth of experience is another way of saying, hey, you're old.
No.
But beyond that, the only parallel is simply the sustained upward march of the markets themselves. I don't think the underlying factors are all that comparable because the dot-com bubble really involved a countless number of businesses that were never sustainable, pets.com and so forth. And that's not the case here. The biggest investors in AI, we all know, are huge, powerful, highly profitable companies from Meta to Amazon to Google and so forth. So that is a big difference. Whether the question, I think, is whether the promise of these investments is likely to match the size of them. And that is an unanswerable question. You see article after article about OpenAI as to whether the investment commitment, whether the capital expenditures they've committed to can possibly generate a return in light of the relatively smaller size of revenues they have now and so forth. I don't think anybody knows the answer to that question. But if you step back and ask yourself whether markets could continue to march upward like this and multiples continue to march upward like this ad infinitum, we all know the answer to that is no, they can't. If I were smart enough to know when the correction would take place, we could be doing this from my giant yacht, but I'm not smart enough to know, and there is no yacht.
Well, I hear what you're saying about, you think about the comparisons to the 90s, the early 2000s. You make the good point that these are quality, mature companies that we're talking about in many cases. But when it comes specifically to OpenAI, I do think it's interesting to see, basically, I've been calling it spending in a circle. A lot of people have made the point that these deals look a little bit circular. You have a lot of overlapping commitments being signed. And the point has been made that it seems like these companies are closely tying their fortunes together, maybe closer than they have been in the past, Roger. And I wonder what you make of that.
Well, I think one would have to know a lot more of the inside. I think you'd have to be on the inside of OpenAI to really be able to assess that. I mean, these are smart companies. Broadcom, which just announced its own deal, or so many of the others. These are smart, well-run, experienced companies. And I would give them the benefit of the doubt by a lot on the extent to which they know what they're doing. And they're, very established, huge companies. OpenAI is a different story. It's a newer company and so forth. But in terms of the parties that are partnering with them, I think they know what they're doing. Oracle and so forth.
Hey, Roger, I wonder about the backdrop. I was talking with Paul Tudor Jones on my program this morning, and he pointed out the differences between, this October and October of 1999 was back then we had a budget surplus. It's hard for people to believe, but the federal government was running a budget surplus. And we had a Fed that was, hiking rates 4 or 5 more times until the crash. Now we have, obviously profligate spending and a Fed that's cutting into an inflationary outlook. What do you make of the run-up in stocks with that background?
Well, first of all, inflation, while it's not yet down to the Fed's 2% long-term target, is in the 2s, which by historical standards is not bad. So I don't think inflation is a threatening factor at the moment, even though everyone would like to see it lower. And we do have underlying consistent growth. We could talk about that growth because it's like a tale of two cities, with parts of the economy doing quite well and parts of the economy quite a bit less well. But we do have consistent, solid growth. And we've had umpteen years of new job growth. So the fundamentals of the economy have been and remain good. In terms of fiscal policy, at some point, markets will wake up, look at the real fiscal trajectory of the United States, and reject it. But there's no sign of that today, and it could be years off. But I think the underlying economic fundamentals are good, and therefore, you know, market levels, while perhaps it's hard to explain the stratospheric levels you see on the Mag 7 and so forth, market levels are supported by a solid economy and good, consistently good corporate profits.
Mm. And so,
I mean, the number of corporations that consistently are beating consensus is very high, including the banks this morning.
right. And Roger, we only have about a minute left with you, but I do want to get your perspective on the deal-making landscape as well, because for a while we were seeing equities go higher and higher and not seeing really the IPO window open back up. We weren't seeing deal-making come back in a big way. It feels like that narrative has changed a little bit. Certainly you're seeing a lot of deals come through. We saw that in the big bank results, but it feels like we've been here before. We've seen false dawns before. Do you think that this current wave, this current bout of deal-making is something sustainable?
Actually, I've been surprised that it took this long for levels of merger activity and transaction activity and financing activity to strengthen. Because fundamentally, if you look at M&A is strong when you have the following ingredients in place: a solid economy, a good business outlook, relatively high stock prices, and favorable financing conditions. All of those ingredients are in place, and they have been for a little bit. So it's not a surprise at all to me that deal making is strengthened now. I was more wondering why it took this long.
Mm. All right, Roger, great to get some time with you. Hope to speak again soon. That is Roger Altman. He is founder and senior chairman over at Evercore. Meanwhile, we do have some breaking news in the form of a Truth Social post from President Trump saying on Truth Social that China not buying U.S. soybeans is an economically hostile act. He's also considering ending cooking oil business with China. So reading the tea leaves here, it seems like this trade war still going on. Tensions remain high, and you can see the S&P 500 reacted, currently turning lower, erasing all of its gains. We'll continue to follow that story. This is The Close on Bloomberg. Our stock of the hour today is Walmart. Shares on pace to hit an all-time high as the big box behemoth teams up with OpenAI to let consumers shop its products on ChatGPT. Let's discuss with Mandeep Singh. He is the global head of technology research over at Bloomberg Intelligence. So just the sphere of influence here for OpenAI continues to grow. We've been talking so much about their deals with chip makers and cloud businesses, but here we are with Walmart.
Well, right now, every company is trying to put out a press release with OpenAI because it really looks good. And look, in this case, I think e-commerce is a big opportunity for ChatGPT because when you look at their volume of queries, they're almost 25% of Google in terms of the number of queries per day. But then you look at their revenue from search ads or just monetization, it's not there. So they're trying to kind of cater to the commercial queries. And the way they're going about it is very different from the traditional e-commerce because this is more an API-driven purchase. Everyone has to expose their catalogs in the form of an API. And look, this is not the first time any company is trying that. Meta and Google have tried it in the past. They haven't really figured out, what is the best way to take an order and fulfill it. They found ads to be more profitable. This is a different approach from OpenAI.
I mean, I use ChatGPT already when I'm working on my motorcycle, and I say, like, how can I get a new filter for this 2023 Harley Davidson? It'll send me to Amazon. It'll send me to eBay. When can it buy a plane ticket for me? When can it look at bring a trailer and scrape the data for me? When can it do more agentic things?
It could, and look, they're not going to go towards a $1,000 or a $5,000 purchase in step one. So they're going to do it with smaller purchases, which is what they're trying to do. Native experience, when you are browsing and you come up with a detailed prompt, it's going to show you a one-click experience to make that purchase. But you're not going to do that for a $1,000 item right away. So
I want to give it my credit card and give it my bills and let it do my budgeting.
It will be an assistant. That's the hope, that all these companies will have an assistant where you can actually talk to it and it's going to make that purchase.
Mandeep, great having you on the program. Did I talk to you this morning? All day long on television and radio. Mandeep Singh runs technology for us at Bloomberg Intelligence. Coming up, we're going to take you to the closing bell with Steve Sosnick. He is the chief strategist at Interactive Brokers. This is The Close on Bloomberg Television.
Well, let's get back to that Truth Social post from the president. You can see it's sinking the S&P 500 just in the last couple minutes of the trade. President Trump posting on Truth Social saying that his administration is considering terminating business with China that has to do with cooking oil and other elements of trade as retribution after he posts that China is, quote, purposefully not buying U.S. soybeans. This has certainly been one of the non-tariff sticking points in this trade spat between the U.S. and China. And you can see it's coming back and hitting risk appetite just in the last few minutes of this trading day, Matt.
Yeah, I mean, that is a fair assessment. China is going out of its way not to buy soybeans from U.S. farmers and buying them from other countries as well. I saw the headline on the Bloomberg, Trump considering ending cooking oil business with China, and I thought, hang on a second, does Donald Trump have a cooking oil business with China? Which wouldn't surprise me either.
Yeah.
But I then found that actually there has been a lot of controversy, or some controversy and regulatory concern about the amount of recycled cooking oil that we import, not a Trump brand, but cooking oil that we import and use as feed for biofuels. So it's all related to the farm vote, which he desperately needs, or the Republican Party desperately needs to get in the midterm elections.
Absolutely. So now considering the administration terminating cooking oil business altogether with China as it comes to that soybean purchase agreement that just hasn't been able to really bear any fruit. Let's welcome in Steve Sosnick. He is chief strategist over at Interactive Brokers. So, Steve, it just feels like in the past week, trade risk has come back in a big way when it comes to this market and risk sentiment. We had gotten kind of used to dealing with some of the headline risk around the China-U.S. discussions. Now it feels like we're learning those lessons all over again.
Yeah, I think part of the reason, Katie, is that we'd kind of put the trade stuff onto the back burner. It had been all about, OpenAI and all things related to it and all the various, shall we say, circular deals that they're involved in. But then all of a sudden, that 100% tariff talk last week was a, big splash of cold water. Now, to some extent, I think that it also functioned as letting the steam out of an overheated system. I do think we needed a little bit of a breather there, and I think it came a bit abruptly, and now I think we're reckoning with it. But today this was another example of how resolute the markets are in terms of dip buying. I wrote a piece earlier today, death, taxes, and dip buying as three things you can just rely on all the time. And then, but then of course, once again, who knew that cooking oil was a thing? And then down it went.
Well, that's the thing, right? It feels like we've been battered by so many issues that folks hadn't necessarily been read up on. It's one thing to keep abreast of all the different tariff levels, but then there are all these non-tariff issues to try to make sense of as well. But let's talk a little bit more about that dip buying impulse, because it certainly looked like it had been working. Now it's getting snuffed up just in the last few minutes of the trade. But overall, we've been so close to all-time highs, these incremental inches higher. And I just wonder how much longer we can continue to proceed that way.
Well, we can keep proceeding that way as long as people believe in this. And I think as long as there's fresh money to come in, it requires basically continual amounts of money, because if think about it this way, if you're fully invested, you need more money to come in, because if it dips, then you either have to sell or find more fresh money to do it. But money does keep flowing in. We saw you know the ETF business as well as anybody. You saw BlackRock's numbers. People are putting money into ETFs. People continue to put money in the market. Last week, before the Friday follies, let's say, VU actually popped up as one of the most active names on our list, which tells me that investors were among our most active customers, because that's an investing name, not a trading name. And for that to be in among our top 25, that was kind of a big deal. That said, it fell off the list again because we're back in a trader's market.
Now, VU is the S&P tracking fund from Vanguard?
Yes.
Okay, Katie knows the most about ETFs because she writes the ETF IQ newsletter.
It's a household name.
And I just want to tell people that you also anchor the ETF program.
Thank you. Mondays at 12 p.m. Eastern.
There you go. I was talking with Paul Tudor Jones this morning. I may have mentioned that. And he makes comparisons. He draws comparisons between this October and October of 1999 and says, at the time we had, a little drop, more than 2.7%. It was 11% intraday, peak to trough. But then we were up 92% before the end in March of 2000. What do you make of that comparison?
I don't think it's necessarily wrong. I'm going to say history doesn't repeat, but it often rhymes. I think we're sort of in a rhyming period of that. To me, the biggest rhyme, and I alluded to the circular deals with OpenAI, right now, late 99, one of the things that was really pushing the market higher was the rush to build bandwidth. We had to build bandwidth. This internet thing was coming, and it's going to be huge, and we've got to get the bandwidth out. Let me stipulate the internet thing was rather huge. And we did need the bandwidth. But let me throw some names: Lucent, Global Crossing, WorldCom, Enron, among some of the companies that were building the bandwidth. It didn't work out for them.
Right.
And so I'm getting the sense now that with, I have to ask the question, where's OpenAI going to come up with $500 billion to meet all these commitments? And I do think that mindset is creeping in. Institutional investors are definitely thinking about it, talking about it. On the other hand, their FOMO is so profound that they can't not be invested in these names. So yeah, I could see this having that echo or that rhyme, as it were, Matt. Although we can analyze and nitpick, it's not exactly the same, but I can't criticize that analogy.
On the other hand, we've seen incredible earnings growth from not just these Mag 7 or Great 8 companies, but Nir Kesar wrote a post yesterday. We were talking to him and pointed out that 95% of S&P companies are expected to grow earnings next year. So they're actually making money. They're not only showing revenue, which was a big no-no during the dot-com bubble, but they're actually earning cash. So that's a big difference, right?
It is, and that's why this is very different, because the names, the names that even were profitable back then were not making this kind of money. Cisco was profitable, wasn't making this kind of money. Nortel was profitable, wasn't making this kind of money. Nortel, of course, went broke from doing this. So we're not in the same, by no means. I mean, the companies that are driving this bus, like Microsoft, et cetera, are just cash flow generating machines. So in that sense, it is quite different. And so, again, the parallels only go so far.
Yeah, it's a good point of context there, but certainly, like you said, it feels like some of these questions are starting to be asked when you see these mega commitments coming from OpenAI. Steve, have to have you back soon. Great to spend some time with you. That is Steve Sosnick. He is chief strategist over at Interactive Brokers. And Matt, we were almost there, almost at a green finish when it comes to the S&P 500. Looks like we won't quite get there.
Yeah, because of the most recent Truth Social posts on China, and it's just another illustration of the fact that China has been driving this market from Friday's drop to yesterday's gain to today.
All right, the closing bell starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
All right, we are about 2 minutes away from the end of the trading day. Katie Greifeld and Matt Miller, he's in for Romaine Bostick. Here to help take us through the closing bell, we're joined by a global simulcast. Carol Masser and Isabel Lead in for Tim Stenovic. We bring together all of our different audiences, Carol, and we were just talking about how we were so close to seeing another green finish for the S&P 500, but those trade tensions coming back in a big way just in the last 15 minutes or so.
Yeah, the president putting out on social about soybeans in China, and so the tit for tat continues. Yeah, keeping an eye on that. Having said that, guys, with big banks starting to report, not everybody got a warm reception on Wall Street. You do see the KBW Bank Index up about 1.7%, so we are seeing some outperformance as a whole when it comes to the bank names.
And I've been driving Carol crazy by talking about crypto all the time, but
Not
crypto
crazy.
is also red on the screen. Bitcoin is down by almost 3%. Ethereum is leading the broader downturn after Friday when the industry saw one of the worst sell-offs in history. They're also all down. It's basically red on the screen. If you type CRYP, go.
That's interesting. You do have gold actually rising. And I look at that because when you say Bitcoin now, I think debasement trade, right? But gold is actually up 0.75%. So spot is at 41.41, which, if I'm not mistaken, would be yet another record high for the yellow metal.
It has been just nuts trying to follow gold so far this year. I mean, you've had twin rallies when it comes to gold, when it comes to equities, and that's certainly what you're seeing today, or you had been relative to the last 15 minutes. Anyway, the S&P 500, it will finish just slightly lower, just about 0.1%. We are very close to all-time highs, even with that puke that we did see on Friday. The NASDAQ down a bit more, down about 0.7% when it comes to the NASDAQ. The Dow Jones, we look at that for some reason, higher by about 0.5%. It's a price-weighted index, so I don't know how much salt you want to put there. But in any case, Carol, it looks like we did see that decline, but very, very tepid losses overall.
Katie, hating on the Dow again. I'm just going to put it out there.
Myself.
I know. S&P 500, let's go back there, folks. Despite down for the day overall, you look inside the index, Matt, and you've got 389 names actually in the S&P 500 gaining ground today. 113 to the downside, 1 unchanged.
I was a young buck doing my first Wall Street internship at Tucker Anthony.
Tell me more.
The John Hancock Company, back when the Dow crossed through 6,000.
What did you do? How did you celebrate?
And you know what? I was the guy in the office. I was the kid who could use the Bloomberg terminal.
Wow.
And so that was like my only skill, and I didn't do much else.
Did they call you Maddie back then? I just called you Maddie on air when we were getting ready to come to you.
Guys.
I don't think so. Here's the IMAP, which is a look at the industry group breakdown on the S&P 500. You can see that the tech stocks are not saving the day, down about 1.5%. Although the index is only down by 0.2%. So you did have more groups winning than losing. And as Carol points out, the financials are the biggest gainers, up about 1.2%, even though JP Morgan and Goldman Sachs both fell after earnings that beat analyst estimates.
Right, kind of impressive to see that. All right, so let's get to, Matt kind of setting me up really well. Let's get to some of the individual gainers, if I may. So we know that Citi and JP Morgan and Goldman not having such a great day and not getting such a warm reception on Wall Street. Having said that, Citigroup and Wells Fargo certainly did. They showed some outperformance. Citi at the close here up 3.9%. Wells Fargo a gain of more than 7%, some real outperformance. Wells Fargo, by the way, the top gainer in the S&P 500 today. You did have them beating Wall Street revenue estimates across all 5 of its major business lines. Total revenue jumping 9%. Markets, banking services. I mean, these companies really some outperformance. For Wells Fargo, we talked to Allison Williams here on Bloomberg Business Week Daily. And, finally, it seems like they are just kind of getting their house in order and their metrics really impressive. And because we know that they've had a couple of years where it's been really, really tough. So anyway, real outperformance in those, and we get ready for some more big banks tomorrow. Advanced Micro was up 4%, finishing the day with a gain of about 0.8%. Top gainer in the stocks today. AMD coming out saying Oracle will deploy a large batch of its forthcoming M1450 chips next year. So Oracle is going to put about 50,000 of those semiconductors in data center computers starting in the third quarter of 2026. So we've just seen a lot of announcements between chip companies and other companies involving AI. And
by the way, who even knows? Like, Who even knows how much that is? 50,000. Is that a lot of chips? Is that a little chips?
I don't know.
We throw around these massive numbers, right? With about gigawatts of power, and I no longer know 50,000 chips is a lot.
It does make your head spin.
I've just got to say, Ian King, I'm watching a monitor, and he's just getting ready and set up and sitting down. We're going to actually ask that question to him in just a moment. And Walmart, got to mention them, up about 5% in today's session. Stock on pace, I think they closed maybe at a record high today. And that's after an AI announcement from the retail giant, which we will get to more on that in just a moment.
Let's get to decliners. We have shares of Fannie Mae and Freddie Mac ending the day lower, with each stock seeing their fourth straight day of losses. Fannie Mae is down by 8%. Freddie Mac is down by nearly 10%. Bloomberg Intelligence says that investors are finally starting to see dilution risks. So in August, Bloomberg reported that the Trump administration is considering selling shares of Fannie Mae and Freddie Mac in an offering that could start as early as this year. Up next, we have Orion. I should have asked Carol how to pronounce that, but shares are tumbling down. They were down as much as 23%. That's the lowest intraday since August 2024, but they closed the day lower by just 16%. So this company supplies chemical products like carbon black for coatings, painting inks, rubber, and other applications for electric vehicles. So the company cut their guidance. That comes as management reduces production levels and as we see continued weakness in the tire industry.
Orion.
Is it Orion?
It's the hunter whom Diana loves.
Thank you. I should have asked you, Matt.
Yeah.
Okay, last we have Sencor. It's down by more than 10%, 10.9, almost 11. It tumbled as much as 17% intraday, most since May. So this comes after RBC said that a leaked abstract for the biotech's experimental antibody for patients with renal cell carcinoma, maybe Matt would know more about that also, may suggest interplay, and the future efficacy will determine path forward. That was really a mouthful.
Okay, let's get to the bond market.
Done.
It was actually open today, not like yesterday. We can actually check yields right now, and you can see there was a little bit of a rally when you take a look at the front end of the yield curve. We did hear from Fed Chair Jerome Powell basically saying that we could see further declines in job openings that might show up in unemployment, but overall, it seems like rate cut expectations pretty much unchanged versus where we were yesterday. A slight rally when it comes to the front end, a little bit of weakness when it comes to the ultimate long end, but overall, a pretty quiet day overall when it comes to the bond market, Carol.
All right, welcome, World, to your new search engine. This story we've been talking about here at Bloomberg. Walmart partnering with OpenAI. Who isn't partnering with OpenAI at this point to offer shopping on ChatGPT? So users will be able to basically shop Walmart's assortment directly on ChatGPT by clicking a buy button, with the catalog including apparel, entertainment, packaged food, and other products. But I just do feel like we need to think about ChatGPT as just our new search engine.
Or Claude.
Or Claude. Or Gemini, or right?
Llama.
My main gripe here is that fresh food isn't included in the offering, partly because consumers buy similar products weekly. But that's exactly why it should be, because I do my shopping online, grocery shopping, and I forgot to order eggs last night. I mean, I want AI to remind me that every week you need to order eggs. So I think they should include that.
It's coming.
Well, I also use ChatGPT to cook. Do you not use ChatGPT for recipes?
I don't cook or use ChatGPT.
It's helpful. So in that case, I agree with you, Isabel.
I will say it is amazing to see Walmart shares react so strongly to this news, closing up at a record high, up nearly 5%. If only OpenAI was a public company, we could check in on those shares as well. I would imagine they'd be skyrocketing. But
wait, when you say fresh food, does that include Pop-Tarts?
Oh, good segue.
Or Doritos?
I don't know if Pop-Tarts count as fresh food.
Definitely not, Katie.
But good news, they're going to have more protein. This is a really interesting story coming out of Kellanova. That is your Pop-Tart maker, that apparently the new versions of Pop-Tarts will have 10 grams of protein per serving in 3 different flavors, which is exciting for the subset of the population that is really into protein right now. I am among them. I don't know if I will be trying protein Pop-Tarts, but you saw Starbucks, for example, recently introduced protein lattes and protein cold foam. It's everywhere.
Have you tried a protein latte?
Of course I have, Isabel. It costs too much money. They're not bad, I have to say.
Tasted dusty to me.
I'm just going to point out in this story, it says that the sugar content will be similar to regular Pop-Tarts, which have about 30 grams of sugar per serving, depending on the flavor. That's roughly 60% of the recommended daily intake.
It's not health food.
But 200 calories a serving, 10 grams of protein and 200 calories, that's pretty good.
Relative to the benchmark, which is a normal Pop-Tart, it's not bad.
But Maybe we should get protein from Real Protein.
Yeah, maybe we should
Just
be eating
saying.
those eggs that Isabel forgot to buy.
Tuna.
Like eggs. Like eggs. That's Real Protein.
Exactly. Thank you.
There you go.
Just going to say. All right, that's a wrap. Enough proteins and enough Walmart and ChatGPT. All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Matt continuing there on the Open on Bloomberg TV, and Isabel and I continuing right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
And coming up on the close, big concerns from small businesses. We'll speak to Holly Wade. She is Executive Director of the National Federation of Independent Business Research Center as small business optimism falls to a 3-month low. This is the close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Welcome back to the close. I'm Katie Greifeld.
And I'm Matt Miller. Let's take a look at where markets closed out the day. The S&P actually fell at the end of the day. We were rallying for quite a while, but then we had another tweet from President Trump, or a Truth Social post, in which he said the soybeans, the fact that China isn't buying them from the U.S., is a very bad thing, and that he might end the cooking oil business. Apparently, we import used cooking oil. NASDAQ also down at the end of the day, 0.7%, so much bigger drop there. The 10-year yield has been holding pretty steady throughout the day. It was closed yesterday, right now 4.02, almost 4.03. This morning we were at 4.01. And then the VIX coming back up to 20.79. I heard Katie at the top of the show say 19, which relatively good for the past few days.
Yeah, you weren't
right?
actually here yet, but I did say that we were at like 19.5 when the show started. So really volatility coming back just in the last hour, 2 hours or so. And you talk about that Truth Social post from the president. It actually knocked the wind out of the sails of AMD. AMD was riding high today. We got the news that they got a big AI chip order from the likes of Oracle. That resulted in an AMD rally, but paired all the way to just 0.8% higher. But even still, that was enough to really drag NVIDIA down lower. NVIDIA shares finishing the day down more than 4%. But I also wanted to highlight Walmart. While we're on the topic of AI, the news came out that Walmart and OpenAI are partnering together. OpenAI trying to get into e-commerce there. Walmart shares up 5%, closing at an all-time high. But let's get to our top story this hour, and that's overall a volatile session on Wall Street. As we discussed, equities really took a leg lower in the final minutes of the trade on Trump threats on China. Remember, earlier in the day, we saw stocks rebounding with Fed Chair Jerome Powell reinforcing speculation of that October rate cut. This as traders try to parse through a very scant economic calendar. Today's NFIB Optimism Index showing sentiment among small U.S. businesses falling to a 3-month low, Matt, really citing less optimism about the economy. So some worrying tea leaves there.
All right, let's talk to Holly Wade about that then. She is the executive director at the NFIB Research Center, representing a lot of those businesses. And Holly, I wonder what the biggest concern is. Is it the uncertainty in trade? I would guess that tariffs and uncertainty in trade is the biggest worry for these smaller businesses that have a much more difficult time dealing with it than large ones.
Well, certainly uncertainty is a key component in their inability to effectively operate their business. As you mentioned, our headline measure of the small business economy, our optimism index, shed 2 points. And that was, though, from the second highest level or second highest reading of the year, the highest reading being back in January. So that 2-point decline is certainly of concern. Still in a fairly okay position. It remains above the 52-year average for the index. But that decline did showcase some hesitation of small business owners. More were saying that they fear that business conditions will worsen than get better over the next 6 months. And there were more respondents saying that current inventories are too high. And so those two components, including the elevated level of uncertainty, are what we're paying attention to at NFIB.
I saw a quote from Dr. Dunk Holly, and he says that rising inflationary pressures are one of the concerns. I'm referring, of course, to the chief economist, Bill Dunkelberg, over at the NFIB. So inflation really is still a worry here.
It is. We've saw an increase in those saying that it's their single most important problem in operating their business. And we also saw that the two price questions that we have included in our questionnaire, actual price increases and price plans, both were above the August numbers. And so both of those are, elevated. The number saying that it's their biggest problem has increased. But still, when asking the population of small business owners in our survey about their single most important problem, it continues to be labor. So whether it's labor quality or the cost of labor, that's around 29% are including kind of both of those in a bucket. Labor is their biggest issue going forward. So while inflation is climbing up a bit, labor is the biggest issue for most small business owners.
That's really interesting. And I see, the figures here, 18% of small business owners cited that labor quality was their biggest issue in September. Talk to us a little bit more about what that means when these small business owners are trying to go out and hire. Basically, they're not finding the skills that suit the position.
Yes. So, we are looking at kind of all the data sets that are out there, and it does appear that, for small business owners, the number of jobs created has been on this decline for a while now. And it's kind of two sides of the coin. So while some industries aren't interested in hiring, some are even shedding employment numbers at their firm, there's still this whole cohort of business owners in certain industries, specifically construction, that are having a really hard time finding people to fill those open positions. So whether they're in retail or residential construction or commercial construction, they're really trying to find applicants for those open positions. And while this has been kind of a pervasive industry of tight labor market over the last number of years, it is still one of the areas that we're seeing a lot of challenges for those business owners.
Well, Holly, the natural question when you mentioned some of those professions that are having a hard time finding workers, such as construction, how much has immigration and lower immigration levels been a factor here when you think about certainly the current setting?
Sure. So it's certainly a contributing factor for some small business owners. But this has been a problem that, has been kind of carried through since 2010, 11, 12. So even back then, while we were, slowly expanding and construction was coming back online after the financial crash, we're still in that period of, not having enough of those employees with those types of skills available for especially those small businesses. We're also hearing of some complaints anecdotally about those that are around data centers, and that those data centers that are being built across the country are also pulling from that pool of skilled workers that might otherwise have been employed by small firms.
That's really interesting. I hadn't heard that one before when it comes to the data centers, but it certainly makes sense, Holly. Unfortunately, we have to leave it there. Great to get some time with you. That is Holly Wade. She is Executive Director at the NFIB Research Center. Now, coming up, how private assets could change the game for the pension plan playbook. We'll speak to HarbourVest Partners CEO John Toomey about how his $146 billion private equity giant is getting involved. This is The Close on Bloomberg. We'll call the 401k gold rush. The country's top asset managers are hunting for the fastest way to access the roughly $12.5 trillion sitting in U.S. retirement plans, following President Trump's executive order clearing the path for alternative assets inclusions in 401ks. Now, our next guest sits at the helm of $146 billion in AUM and says that the move to open this door is really going to usher in an era of smarter, more inclusive retirement investing. Joining us live in studio, I'm pleased to say we have John Toomey. He is the CEO of HarbourVest Partners, an independent private investing firm. John, great to see you in person.
Katie, thank you for being here.
So let's talk a little bit more about the concept of putting private assets in 401ks in the U.S. retirement system, because you know, some of the pushback has been, you think about the public equity markets, the public bond markets, returns there look pretty good. So what benefit does putting privates in actually accrue?
I mean, when you look at long-term investing, you look at institutional investors all around the world, thousands of them, pension fund, defined benefit plan sponsors have all allocated a portion of their assets to private markets because over the long run, private equity in particular has shown an excess return over public markets.
We have got, though, transparency in public markets, right? And in private markets, I guess a retail investor would have to rely on a fiduciary to oversee those companies or those investments.
I think that's right. I mean, I think being a good fiduciary, particularly those private asset managers like ourselves who have been in business for nearly 4 decades, we're good fiduciaries for thousands of pension benefit plans all around the world. And I think under the current regime, it's not been allowed to have individual investors in savers invest into private markets. And I think the executive order is the first step in that direction, given the opportunity for a broader universe of American savers.
So I'm also curious to hear your thoughts on timeline, but let's say that this happens and we do start seeing private assets in 401ks. How should one think about what that looks like? I mean, should you have your public and your private bucket, or at the end of the day, is it all equity? Is it all fixed income?
I mean, we started to see in the institutional spaces there historically been 2 buckets, but increasingly institutional investors are actually just thinking about as equities. Some are public, some are private. Importantly, if you're going to have diversification, which we've seen in the public markets as the only proven guardrails for many decades, it really should include private assets. And the proportion of which are private assets should really depend upon what a saver's duration is. A 30-year-old would have a very different portfolio than somebody who's approaching their 70s.
I wonder if it's just private assets or if it's really alternatives in general, because a lot of retirees already have access to alts. If you're a teacher, if you're a cop, right, you have TIAA CREF or you have CalPERS, and they're investing heavily in alternatives. So should the average retail investor or retiree who's not involved in one of those plans be able to access all alternative investments?
Well, that's exactly right. I mean, there are many pension savers today who participated in a defined benefit plan, just like my parents did while they were alive. And so they had the benefits of private market investments. But if my parents were 30 years younger and they had a 401k instead of a defined benefit plan, then they would not have had the benefits. They would not have as a secure retirement as they did while they were alive. And so I think the opportunity should really be to give today's American worker the chance to have a secure retirement the way that our parents' generation did.
I want to change it up to a couple of macro questions and ask you as an investor what you think of this environment, because we continue to bounce up against all-time highs. Okay, Friday we had a big slip,
it was ugly.
Right? But we're still there, and we're still at tights when you look at credit spreads. We're down at 4% on yields. Are we in a golden era here? What's happening?
Yeah, so I look at it in private market investing. Obviously, there's some subject to the overall macro environment. But when you invest in a company, whether it's a venture-backed business for many years or you take a business private and you hold that for 3, 4, or 5 years at a time, the source of excess returns that we've seen in private markets has less to do with the exact interest rate at a moment in time or what the public equity markets are doing, but just good stewardship of those assets, alignment with the underlying management team, and most importantly, the ability to invest over the long run without focusing on quarterly earnings, quarter in and quarter out, like you have to do in the public markets.
Yeah, well, certainly that is also something President Trump is trying to change when it comes to reporting requirements. We have just about a minute left with you. I do want to get to this point that you made in your notes that you sent over to our producers, that you think about the typical private equity portfolio, it would be concentrated by most standards. So if we do see these types of funds, these portfolios get included in 401ks, what needs to change there?
Look, I think the debate in Washington should not be whether we should or whether we should not. I actually believe that the debate should be, how do we do this? How do we give this opportunity and be more inclusive to all of the broader universe of Americans who are saving their hard-earned dollars? And diversification is the only proven guardrail that we have seen in the public markets, and it's logical to just take that, bring that to private markets, and as long as investors invest in diversified private markets, they'll enjoy the same benefits that others have received for many, many years.
All right, John, really appreciate your time. That is John Toomey. He is the CEO of HarbourVest Partners. Now, coming up, President Trump throwing Argentina a $20 billion lifeline. We'll unpack the implications with Hans Humes. He is the founder, CEO, and CIO at Greylock Capital. That conversation up next. This is The Close on Bloomberg. Well, the S&P 500 turned lower in the final hour of the trade after, you guessed it, a flare-up in the trade war with China. President Trump threatening to stop trade in cooking oil with China in a Truth Social post, a retaliatory move after Beijing is continuing to refuse to buy American soybeans. Joining us now is Balance of Power co-host Joe Mathieu. So, Joe, it feels like a little bit we're back in an environment where there's so much headline ping pong when it comes to what is the state of play with trade negotiations with China.
Yeah, it's been kind of a day-to-day up and down here, with the president being accused of pulling another taco over the weekend following his very aggressive post on Truth Social on Friday, sent the markets in a tizzy, then the relief rally yesterday, and yes, today. I'm guessing you didn't have cooking oil on the menu for the program, but that's what the president's talking about on Truth Social, and this post helped to send the markets lower. With China not buying soybeans, we know that's been the case now for some time. He calls it an economically hostile act. He says China purposefully not buying the crop, and we're considering terminating business, he says on Truth Social, with China having to do with cooking oil and other elements of trade as retribution. He says we can easily make our own cooking oil, and it's unclear if he's talking about the new stuff that we buy at the store and cook in ourselves, or the massive imports of used cooking oil from China that goes back to, as a matter of fact, the Inflation Reduction Act, a Biden-era piece of legislation, now law, the IRA, that in fact created incentives for renewable fuels like, yes, used cooking oil. Now, guys, I don't know if this is going to be the path to a deal with China. The president is supposed to sit down with Xi Jinping in just a couple of weeks at the APEC summit in Korea. The administration, by way of the Treasury Secretary, is still saying that that meeting is on. And we heard from USTR Greer today saying they even have a time. We haven't seen that publicly, but they have a time to meet, and that has not changed yet.
All right, Joe, thanks very much for joining us. Bloomberg's Balance of Power co-host Joe Mathieu. I look forward to the program today with, I guess, Julie, Rick, and Jeannie, starting at 5 p.m. Keeping the focus right now on President Trump. He's been meeting with Argentina's leader at the White House, announcing a $20 billion financial rescue for the nation, or detailing that announcement that we already knew about. It marks Trump's second attempt to throw Argentina a lifeline, and joining us to help unpack the implications of this bailout is Hans Humes, the founder, CEO, and CIO of Greylock Capital, who has decades of experience and I don't mean to say that you're so old, Hans, but you have a lot of experience in the world of sovereign debt, distressed debt in Argentina. What do we know right now about, the basic details that I always call you and ask you about? How much money does Argentina have left to back up the peso? How much money has the U.S. Treasury spent to back up the peso? And how much are we willing to spend to help them further?
I mean, those are all really good questions. It's a bit surprising in a way that we've put together this program because, in emerging markets, when you have these countries that have an overvalued currency and you start to get stresses on the system, if things break on the foreign exchange side, things can get pretty bad pretty quickly. And the $20 billion headline number, if things really go sideways, won't be enough to sort of stop the bleeding. What is expected is that there'll be some sort of conditionality, that you move the ban and then you float the peso. And if Milei starts heading towards some kind of a dollarization, what you want to avoid is what happened in Ecuador when they dollarized. Interestingly enough, the president at the time was this guy, Jamil Mawad, so he had the same initials as Javier Milei. And there was an overvalued sucre, some plans for a dollarization process, which Milei brought up quite a bit in his campaign prior to the election. But Mawad lost control of it. They ended up dollarizing, but after a very disorderly devaluation, and it cost Mawad the presidency of Ecuador. So quite a few pretty accomplished economists have been opining on this and what needs to be done to stabilize the situation in Argentina. The headline number that the U.S. has won't be enough if it's disorderly. If there's a very well executed plan of sort of a step-by-step devaluation, I think you can get the situation in order. A concern I think some people have is Trump coming out today and sort of tying the follow-through on the aid to the election results, the upcoming election. And I think there's a bit of an underappreciation sometimes in D.C. That, you know, if the U.S. is too prominent,
right,
it can be a disadvantage. There's an undertone of anti-imperialism in Latin America that people don't pick up. So let's see how the elections go. And I would assume, I mean, obviously, Secretary of the Treasury Bessent knows about the valuations, and I would expect that there's a thorough plan on how to achieve some stability in Argentina.
Well, Hans, to that point, I mean, what is your best guess as to what happens on the 26th when we finally get to those midterm elections? You make the good point that too much of anything is probably a bad thing. That could be the case with American support. But what the U.S. has done so far, what they've provided so far, do you think that's enough to get Milei over the line?
But yes and no. I mean, if you sort of sequence the announcement of the numbers and a program, you know, clearly the market rallied when the details of the program started coming out. But you're dealing with a country that's been through quite a few of these cycles, and you don't have to look back too far back to see what happened under Macri when there was the IMF bailout, and they still had to go through a pretty severe restructuring. There needs to be a plan behind it. And again, it's not necessarily a positive that the U.S. is making themselves so prominent right now. It's also, I mean, you see a pretty big disconnect between some of the headlines that you see about the Argentina elections, the Buenos Aires election, what's coming up now, in the Argentine press versus what you see here. A lot of the spin around Buenos Aires was voters reject market reforms. If you talk to people in Argentina, it's, you know, corruption around Milei and sort of a lack of empathy. And the spin with him is this, you know, there is this guy campaigning with Wall Street or with the Argentine population. So we'll see if there's any change in polling numbers. But my concern is that the election results won't benefit Milei, and it would not be a good thing for the U.S. to pull back too much and too obviously if the election results don't go the way Milei and Trump want.
We don't have to get into the bribery allegations, but suffice to say, you know, Javier Milei and his sister Karina have had some issues along the lines of Tom Homan. And they were supposed to be cleaning out the corruption. I wonder, Hans, why the U.S. would be so interested in helping out Argentina, besides the fact that Trump thinks it's one of the most beautiful countries he's ever seen, and besides the fact that, you know, he likes Milei, and especially that Milei likes him. Is this to sort of stop the dominoes of Chinese communism spreading, or is it to get Argentina to refine our rare earth minerals? Why do we want to help them so badly?
I mean, I think there definitely is a sense of sort of teaming up with leaders who are ideologically aligned with Trump, and, you know, to some extent, leaders in Latin America that are seen to be right-wing, Bukele, Noboa, Milei, are going to get more of a benefit with the Trump administration than, you know, left of center politicians. But the China question is a good one. Going back to your prior segment, who's filling in the gaps on the soybean exports to China right now? It's Argentina. So the Chinese stopped buying soybeans from us, started buying them from Argentina. So, we are playing, the United States is playing this in a lot of countries in Latin America, definitely in Africa, where any vacuum we leave, they step in and sort of fill the gap where they'll find another area. In terms of locking in, obviously lithium supplies, quite a few rare earths. Argentina is a critical producer. And I think that strategically, it would be good for the U.S. to continue focusing on these countries that supply rare earths that we're going to need for the sort of next steps in, AI, any kind of technology going forward.
Right. All right, Hans, great to get some time with you. Really appreciate you coming by and raising the point about soybeans. Certainly maybe an underappreciated aspect here when it comes to Argentina as well. That is Hans Humes. He is the founder, CEO, and CIO at Greylock Capital. Meanwhile, a quick look at how markets closed on the day, fading in the last few minutes of trading as trade tensions really came back in a big way. The S&P 500, the NASDAQ 100 lower on the day. The bond market pretty much unchanged. Volatility back in the equity market. Your VIX with a 20 handle. This is the close on Bloomberg. Big banks earnings continuing tomorrow with Bank of America and Morgan Stanley set to report results. Let's break it down with Macrae Sykes. He is portfolio manager over at Gabelli Funds. And before we talk about what's ahead, I do want to briefly meditate on what we saw today, especially when it comes to the likes of Wells Fargo posting its biggest one-day gain since President Trump was re-elected. Would love to hear your reaction, given that the firm does own Wells Fargo.
So what a pleasant surprise today. I think not unexpected in terms of that guidance. I think the timing of it was quicker than we would have expected. They just got out of the asset cap and they've been making progress, but it was a really nice announcement to kind of have that confidence from management at this point in terms of those targets being 17 to 18%. And that's a reflection of the simplification that they've taken over the last couple of years to, really kind of reduce the platforms to a couple core businesses. They're generating better returns out of those businesses today, and they've taken a lot of costs. So they hope to get to about $15 billion this year. And so that is helping the efficiency. And then now that they're a little bit more comfortable with the capital level, that will start to come down, increase the ROEs. And so here you have a firm executing very well, great strategy, and now on offense after being in the penalty box with the asset cap for so many years.
Macrae, we showed a share buyback chart earlier, and it's pretty striking how much more these banks are spending buying their own shares than they did in the same quarter last year. And I also thought it was fascinating that JP Morgan came out and said, we don't feel terribly comfortable buying our shares at this level, at these elevated levels. What do you think about banks continuing to return money to shareholders after the Fed stress test? They pass them with flying colors. Will that go on into the fourth quarter?
Right. Well, I think with JP Morgan, especially now we're over $300 or close to $300, over 2 times tangible book. I think there was a time, not too long ago where Jamie said, I wouldn't even buy stock over 200. And we did see that buyback. And I think there's a trade-off now of retaining that capital in this new capital world where they'll get some relief. So I don't think that they're really maxing out at JP Morgan in terms of the buyback. They're doing some for offset some of the dilution for the employees. But, they're retaining that capital. And they announced an initiative the other day, which will be deploying capital in a differentiated way in terms of making investments. And they hope to hike the dividend, et cetera. But it is pretty pronounced in terms of the capital returns, just given the fact that the entire banking industry has been much more recapitalized over the last decade. And so it's a good thing for shareholders to be getting that capital back. But, obviously, we'd rather have it at more depressed multiples.
And so let's look ahead to tomorrow as well. We got a lot of the big ones out of the way today, but you think about what we have on deck tomorrow, Bank of America, Morgan Stanley. What can we extrapolate out from what we heard today versus what we're going to hear tomorrow, and what we might actually see in terms of the reaction, because JP Morgan putting up strong numbers but still sinking on the day?
So I think coming into today, we had high expectations, premium valuations, whether it's JP Morgan, or Goldman Sachs. And so the markets business has been widely anticipated. IPOs in the third quarter were almost 100 versus 50 a year ago. So we know the engagement, we know the issuance. And so I think coming into this quarter was not unexpected to get pretty strong results there. And you're seeing some tempering, I guess, with expectations going forward. And so you probably, with a business like Bank of America, market dependent, wealth, et cetera, some good results there, certainly markets revenue, et cetera. We would expect that same fundamental progress, but perhaps more muted response to those returns, even if they do exceed. And then for Morgan Stanley, much of the same thing in terms very strong IB revenue, just given their tie there. And we would also look to the wealth management results in terms of pre-tax margin, just given the asset levels of the whole environment, especially with the stock market at record highs.
Macrae, great to get your intel. Thanks so much for joining us. Macrae Sykes there is a portfolio manager at Gabelli Funds. Still ahead, what investors need to watch over the next 24 hours. We're going to do that, right?
Yes, we are.
What they need to watch over the next 24 hours, including earnings from United Airlines. This is Bloomberg. United Airlines set to report earnings tomorrow, a week after Delta disclosed better than expected demand for its premium seats and main cabin. Joining us now is Sheila Kahyaoglu, Managing Director and Senior Airlines Equity Research Analyst at Jefferies. She has a buy rating on the stock. And Sheila, what is going on here? I mean, in an economy where, slowing jobs growth, and apparently, we're worried about the lower end consumer, and by that I mean the bottom 90%. Why did Delta do so well, and will United do that well as well?
Sure. So we upgraded Delta 2 weeks ago, so we'll take our victory lap there. I think it's a story. I am surprised at how well airlines are doing, but I do think it's a story of haves and have-nots. Delta and United are winners. You're seeing that in the main cabin price spread versus premium, and that spread keeps widening. Premium growth was up mid to high single digits for Delta. Corporate was up 8% year over year. Other economic factors that are more broad-based, like cargo, was up 19% year over year for Delta, and MRO was up 60%. So that's their maintenance repair business. So economic indicators were good, not only overall broad-based, the MRO and the cargo data point I said, but the premium stuff, whether it's corporate and premium as well. So we think United's going to see the same trend. They're going to have some spillover from their Newark issues into Q3, but we are 15% above consensus for 25 and 26 estimates for United, because we think that premium gap continues to widen.
Yeah, it has been interesting to watch that develop, especially in some of these names. Let's talk a little bit about the situation when it comes to Newark Liberty International Airport. I know that investors will want an update on the situation there. What are you expecting to hear from the C-suite?
They've worked on Newark really incredibly hard. And I think United has worked with the government to fix Newark. So we'll see how that pans out. I think United is all about improvement and expansion. They also announced new international routes that last week when Delta reported making some sweeping statements about expanding their international capacity in 5 new cities that can't go direct right now from the U.S. into Europe. So I think Newark, they'll have positive data points there. But still, it's an area of improvement for United, and they've continued to focus on it, and they're doing much better than in Q1 and Q2. And then also about just the United product differential, not only the premium, but the ability to go anywhere with United.
What about right now, Sheila? I have friends who were stuck in LA all day yesterday at LAX, and I'm supposed to fly to the great state of Ohio at the end of the week from Newark on United, and I'm wondering if I'm not better off just driving myself, or like hitchhiking would be more efficient right now because of the air traffic controller situation. How does it look to you?
I'm not quite sure we're there yet. I don't think you need to hitchhike, but I think the shutdown is impacting all elements of the government, with the FAA being one. I'm at an Army trade show right now. That's the helicopter behind me. It's a Textron Bell MB-75. The DoD is delaying contract awards, delaying payments. So I think, it's not only air travel that's being impacted by the government shutdown.
How hard is this hurting all airlines? If this shutdown goes on through October into November and beyond, Sheila, how much of a problem is this for United, for Delta, and for the rest of them?
I think this is the first payment they'll miss. So we're keeping an eye on United and Southwest, which have the most exposure, but not much. It's under 1% of sales. So as we saw with Delta, they said it's under $1 million of revenue per day that it's impacting. So we don't expect it to be a huge issue overall with the shutdown. It's just more of a consumer inconvenience, to be honest.
All right, Sheila, great to preview some of these results with you. Very cool to see you also in front of that aircraft behind you. Sheila Kahyaoglu, she is Managing Director and Senior Airlines Equity Research Analyst over at Jefferies. And on that note, let's look ahead to what we're watching over the next 24 hours. We've walked through a few of them, but it is earnings palooza tomorrow. Bank of America, Morgan Stanley, ASML, United Airlines, and J.B. Hunt, Matt Miller.
Ah, the trucker. Very cool to hear about that. We used to follow the Dow Transport so closely.
You know, Romaine still does.
Yeah, because of Dow theory. That's old school.
Yeah, it certainly is.
But very interesting to see those earnings tomorrow. And it'll be interesting to see also if we get any more news out of the economy. We have manufacturing. We have Empire Manufacturing, so the private releases, 8:30 a.m. And then at 2 p.m., we have the Fed Beige Book, which, you know, in this cutting cycle could be interesting.
Yeah, it's always mildly interesting. It probably maybe takes on increased importance given that we're not getting economic data. So some anecdata there coming out of the Beige Book from the Federal Reserve. We do get some Fed speak as well that we can chew on. Myron and Waller all expected tomorrow after we heard from the big boss today, Jerome Powell.
I'm pumped to hear Chris Waller, I believe, is coming on Bloomberg Television. He'll be on surveillance with John Farrow and crew on Thursday morning, and then he joins Tom Keene and Paul Sweeney in radio.
Will be a lot of fun. He is certainly taking the Bloomberg tour. That does it for us, though, on the close. Balance of Power is up next. Have a great evening.
There's that little building again.